Every financial crisis has two dates: the day the problem begins and the day everyone finally notices. Those two dates are almost never the same. Sometimes they are separated by weeks, sometimes months, sometimes years. In the meantime, companies keep operating, investors keep investing, lenders keep lending, and almost nobody realizes the story has already changed. Nothing looks broken. Until suddenly, everything does. That is the part we almost never see. What happens during the part nobody sees? What happens between the moment a business quietly starts running out of cash and the moment everyone else finally realizes it is in trouble? Because that is when financial risk becomes the hardest to recognize. Not when everyone can see it, long before anyone else can, hidden inside private loan agreements where problems do not always become visible when they begin. Sometimes they only become visible when there is no time left to fix them. Welcome to the world of private credit. But private credit didn't become a $2 trillion market because someone invented a better loan. It became a $2 trillion market because the old system stopped doing a job. After the 2008 financial crisis, banks changed. They had to. New regulations demanded stronger balance sheets. Riskier corporate lending became much harder to justify. From the bank's perspective, that was the point. But businesses still needed money to grow, to expand. And private equity firms were still buying companies. The demand for capital never disappeared. Only one of its biggest suppliers stepped back. Markets don't like empty spaces. Someone almost always fills them. This time, it wasn't another bank. Investment firms stepped in. They began lending directly to businesses. Before long, billions turned into trillions. Deals that once happened quietly in the background became part of the financial mainstream. Today, private credit finances thousands of companies around the world. Yet, despite its size, most people barely know it exists, which leaves one obvious question. If so much lending happens behind closed doors, how do you know when the story starts to change? If you've ever watched a financial crisis unfold, you know what it usually looks like. Markets fall, headlines spread, investors panic, companies default. The warning signs are hard to miss, but this story doesn't begin that way. There are no collapsing stock prices, no television crews outside bank headquarters, no emergency meetings lasting through the weekend. In fact, if you only looked at the surface, you might think nothing was wrong at all. And that's what makes private credit so unusual. The absence of panic isn't always the absence of risk. Sometimes it's simply the absence of visibility. The story can already be changing long before anyone realizes they're watching one. So here's the real question. If trouble doesn't appear on the surface, where does it appear first? For most people, a loan is either healthy or it isn't. The payment arrives or it doesn't. Simple. But only if you believe a single payment can tell the story of an entire business. It can't. Think about your own finances. If you paid your mortgage this month, would that prove everything else in your life was going well? Of course not. Maybe you emptied your savings, delayed replacing your car, or decided that one payment mattered more than everything else. From the bank's perspective, the payment arrived. Your reality could be very different. Businesses do the same thing, which means the real question isn't, did they make the payment? It's, what did it cost them to make it? Because the moment you start asking that question, you're no longer looking at the loan, you're looking at the business. And those are not always the same story. Every business has two stories, the one everyone talks about and the one that decides whether it survives. The first is easy to find. Revenue, profit, growth. Quarterly presentations are full of it. And the second story is quieter. It rarely makes headlines, and by the time everyone notices it, it's usually too late. That story is about cash. Because businesses rarely fail the day they stop making money. They fail the day they run out of it. Cash determines how long a company can keep paying its employees, its suppliers, its lenders. But above all, cash buys time. And in credit, time is everything. That's why experienced lenders don't stop at asking, did the payment arrive? They ask something far more revealing. How many more payments can this business afford to make? Because that's the difference between watching a payment and understanding a business. Time is the one thing neither borrowers nor lenders can create, but they can negotiate over it. And in private credit, that's exactly what they're doing. When a business starts struggling, it rarely asks for less debt. It asks for more time. Time for sales to recover, time for interest rates to fall, time for the economy to improve. Every struggling business is built around the same hope. Tomorrow will be easier than today. Sometimes it is. That's what makes these decisions so difficult. More time can save a business. Simply postpone the inevitable. No one knows which, until much later. In the end, the negotiation isn't really about money. It's about one question. Is the future worth waiting for? And if the answer is yes, how do you buy more time without spending more cash? There are only so many ways to buy more time. One of them sounds almost too simple. Imagine borrowing money from a friend. At the end of the month, You owe them interest. But instead of asking you to pay it, they shrug and say, "Don't worry, just add it to what you already owe me." You haven't paid $1, yet somehow you owe even more. Private credit has its own version of that idea. It's called payment in kind, or simply PIK. Instead of paying interest with cash, the borrower pays with more debt, which means the business keeps its cash and buys itself more time. Sometimes that's exactly what it needs, but nothing disappears. The interest stays. And next month, it starts earning interest too, like a snowball, small at first, then suddenly bigger every time it rolls. PIK isn't the problem. Time isn't the problem. The question is whether that extra time leads to a recovery or simply delays the ending. From the outside, those two stories can look identical until one day they don't. PIK is only one way to buy time. There are others. A lender might extend the loan, change the terms, or restructure the agreement. From the outside, those decisions can look like signs of trouble. Sometimes they are. Sometimes they're exactly what keeps a good business alive. That's the difficult part. The same decision can rescue one company and merely delay another. There's no way to know which until much later. Every extension asks the same question. Are we giving this business the time it needs, or simply more time before reality catches up? Those two futures can look almost identical, right up until they don't. By now you might be wondering something. If companies are running into trouble, why don't investors see it? Why don't the losses show up sooner? Most of us think about markets through stock prices. Every day, prices move up, down. Every trade reveals what someone is willing to pay. Private credit works differently. These loans aren't traded every minute. There isn't a screen updating their value all day long. Most of the time, nothing seems to happen, and that's where things get interesting. Silence can mean stability, but silence can also mean the market simply hasn't been forced to answer the question yet. What is this loan actually worth today? Until that question is tested, both stories can look exactly the same. Imagine walking into a dark room. You can't see very much, so you assume everything is exactly where you left it. The chair, the table, the bookshelf. Nothing seems to have changed. But here's the problem. You don't actually know. You just haven't turned on the light. Private credit feels a lot like that. These loans aren't constantly bought and sold. So there are fewer moments when the market is forced to test its assumptions. Sometimes the calm reflects genuine strength. Other times, it simply reflects a question that hasn't been answered yet. From the outside, those two stories look almost identical, until someone finally turns on the light. By now, you've probably noticed the pattern. A loan can keep performing even while the business behind it grows weaker. Not because anyone changed the rules, but because a loan and a business were never telling the same story. A loan tells you whether today's payment was made. A business has to survive tomorrow. Those sound similar. They aren't. Imagine watching a marathon runner halfway through the race. Their breathing looks steady. Their pace hasn't changed. So they even wave as they go by. Everything looks fine. What you can't see is how much they've already spent just to make it look that way. Businesses do the same thing. They keep paying, keep meeting expectations, keep looking strong, even while becoming weaker with every mile. That's one of the easiest mistakes to make in credit. Confusing endurance with strength. They are not the same. Eventually, time forces those two stories to become one. It's easy to look at all of this and assume someone made a mistake, but that's rarely how credit works. Imagine you're the lender. Across the table sits a business under pressure. It's struggling, but it's still operating. Employees still show up for work. Customers are still buying. Suppliers are still delivering. The business isn't gone. It's running out of time. You could force a default today, but then what? Jobs disappear. Suppliers lose a customer. Investors lock in their losses. A business that might have recovered never gets the chance. So you make a decision. What if this company just needs more time? Sometimes that's exactly the right call. Other times it isn't. That's the difficult part. There's no way to know which until much later. Every extension is a bet that tomorrow will be easier than today. On its own, none of this is unusual. One company asks for more time. Another restructures its debt. A lender chooses patience over default. That happens. What changes everything is when they all start happening at once. That's the moment a company story becomes a market story. Not because every business is about to fail, most won't, but because they're all asking the same question. Can we hold on just a little longer? One more extension, one more quarter, one more chance. On their own, those decisions make perfect sense. Taken together, they become a credit cycle. That's how financial systems change. Rarely through one dramatic collapse. More often through thousands of ordinary decisions, quietly moving in the same direction. By now, the mystery isn't how private credit works. It's why so many investors are watching it so closely. Not because a crisis is inevitable, it isn't, but because no one knows how many companies are simply buying time and how many are genuinely finding it. That's the uncomfortable part. Some businesses will recover. They'll make it through. Years from now, this will feel like nothing more than a difficult chapter. Others won't. One day, they'll run out of time. And when they do, it won't feel like the problem suddenly appeared. It'll feel like everyone else finally caught up. That's why experienced investors aren't just asking, where are today's defaults? They're asking something much harder. How many of tomorrow's defaults still look healthy today? Because the greatest uncertainty in credit has never been the loans everyone knows are in trouble. It's the ones that still look perfectly healthy. Private credit may or may not become the center of the next financial crisis. No one knows. And that's precisely the point. This story was never about predicting the next crisis. It was about understanding what happens long before anyone realizes there's a problem. Financial systems rarely break all at once. They change quietly. One extension, one negotiation. One company buying a little more time, then another, and another. Until one day, what looked like patience starts to look like delay. That's the lesson hidden inside private credit. Not that every loan is dangerous, not that every restructuring is a mistake, but that risk has a habit of hiding inside things that still look healthy. Long before the headlines, long before the panic, long before anyone calls it a crisis. Because every financial crisis has two dates: the day the problem begins, and the day everyone finally notices. The hardest part is living in between. If you enjoy breaking down how financial systems really work, consider subscribing. I'll see you in the next cycle.